Hello everybody. At this time we are talking about a financial transactions. A financial transaction is any exchange of money or assets between two or more parties. It is important because it shows how money moves in and out of a business or individual's finances, which can be tracked and managed easily with an accounting system. Understanding financial transaction is key to staying organized and managing your finances effectively. With proper tracking and financial records, you can make informed decisions and ensure accurate records for your business or personal finances. And then we move to types of financial transactions. The first type, sales. A transaction takes place during business sales. During sales, transactions are carried between sellers and buyers when any tangible or intangible services or assets are sold to buyers against money. Sales of any goods or services enable businesses to earn revenue. Other than cash, sales are carried on in exchange for credit. Sales constitute a major part of business income. Sales transactions are recorded by business bodies as account receivables. And then second, purchases. Purchase refers to the process when a business body undergoes a transactions to obtain goods and services and accomplish business goals. The entire acquisition of services or goods is done in exchange for payment. Raw materials are purchased by business entities to make sales. Such transactions are recorded in accounts payables. And then third, receipts. A receipt is a written acknowledgement that acts as a confirmation that the concerned party has received the necessary amount of money or goods after a sale. Such a transaction commences after a business entity receives money for offering a service or product to another business body. And then fourth, payments. Payment involves the voluntary transfers of money or any valuable asset that is equivalent to the amount payable from one party to another for availing of services or in exchange for goods or products. Such financial transactions are preceded by a bill or an invoice. And then we move to steps for recording financial transactions. The first steps, identify the transactions. Determine the nature and parties involved. And then second, classify the accounts. Identify which accounts are affected, like assets, abilities, equity, revenue, expenses, and etc. And then third, apply double entry bookkeeping. For every debit entry, there must be a corresponding credit entry. And then fourth, journal entry. Record the transactions in the appropriate journal. And fifth, posting to ledger. Journal entries to their respective ledger's accounts. And then we move to key characteristics of financial transactions. The first, monetary value. Every financial transaction carries a specific monetary value, which can be represented in various forms such as cash, credit, checks, or digital currencies. This value reflects the worth of the goods or services exchanged. For instance, a transaction involving the sale of a product includes the selling price, while a loan agreement specifies the amount borrowed plus interest. The monetary value essential for evaluating the financial impact of the transactions on the involved parties and for maintaining accurate financial records. And then second, record keeping. Accurate record keeping is vital for tracking financial transactions. Each transaction must be documented in financial statements and accounting records to ensure transparency and accountability. This practice helps organizations maintain clear financial records, which are essential for audits, tax compliance, and performance evaluation. Proper record keeping also enables businesses to analyze trends, manage cash flow, and prepare for future financial planning. The systematic recording of transactions in ledgers and journals is a foundational of accounting. And then third, parties involved. Financial transactions require at least two parties, typically a buyer and a seller. In some cases, there may also be a third party, such as a bank or financial institutions. Each party has distinct rights and responsibilities. For example, the buyer has the right to receive the goods or services as promised, while the seller is obligated to deliver them. Similarly, in a loan scenario, the lender or creditor has the right to receive repayments, while the borrower or debtor is obligated to repay the loan amount along with interest. Understanding these roles is crucial for enforcing contractual agreements and resolving disputes. And then, what are the financial transaction cycles in accounting? The first, sales transaction cycle, includes the financial transactions of shipping goods or providing services to the customers, issuing an invoice, and collecting payment. And then second, purchasing transaction cycle, includes the financial transactions of receiving goods and services, recording the transactions in the account payable, and paying the supplier. And then third, payroll transaction cycle, includes the financial transactions of calculating and recording gross pay, deducting and paying employee taxes, paying employees net pay and employee superannuation or insurance. And then fourth, financing transaction cycle, includes the receipt of money via a debt instruments, a series of periodic interest payments and debt repayments. Financial transactions in this cycle may also include cash receipts from investors and dividend payments. And then we move to advantages of recording financial transactions. The first advantage, accuracy. ensures financial records are precise and up to date. Second, decision making informs strategic business decisions based on financial insights. And third, accountability tracks all financial activities, promoting transparency. And then finally, fourth, compliance meets legal and regulatory requirements. And fifth, financial analysis, provides data for assessing financial health and performance. I think it is enough. Thanks for watching.